the wealthy have a system to pay zero taxes. And so I've brought that back down to upper middle class American. You can actually do the exact same thing. Everybody should be doing cost segregation and making sure that you get that bonus depreciation and that you're paying as little tax as possible. You're not going to just stay in real estate because real estate's going to grow you a large portfolio and a lot of wealth. But then what comes next?
We've been talking quite a bit about wealth preservation, wealth transfer to the next generation. What does wealth mean to you, Carlotta?
Get ready for the next iteration of you on your path to becoming wealthy. On this show, you'll get the insider's view on wealth creation, the class none of us got taught in school, with my co-host, daughter, and beginning investor, Sophia Bosch. And now, let's get started.
Welcome to the Becoming Wealthy podcast. I'm your host, Michelle Bosch. I am so excited to have on today's show a guest that started, I think, her passion for what she does today at the age of 14. And over the course of the years has been kind of like on two different sides of that same, passion. And so I would like to introduce you all to my guest today. Her name is Carlotta Thompson. She's the founder and CEO of Tax Strategist of America. And Carlotta, welcome to the show.
Thank you.
How are you?
I'm amazing. Thanks for having me today.
Thank you so much for being here with us today. I know that you are a former IRS agent, and that somehow in your teens, like at the age of 14, and I'm envisioning this, that you're probably seeing your parents preparing their tax return, around April 15, and somehow a pamphlet is laying in the kitchen table and you are fascinated by it. Or am I completely wrong? Tell us the whole story.
Okay, so when I was 14, I was going through the mail, and back in the day, the IRS sent out these little pamphlets that actually tell you how to do your taxes. And so I was going through the mail and I saw one of these. That's actually how I found it. And I asked my dad what it was, and he was like, "You should start reading it." So I did. And that's really how all this started. I became obsessed with the tax law at 14 years old. And I knew I wanted to go to college and be an accountant. And so I went. And there's a lot of things that happened between there and graduating, but I graduated and went to the largest firm in Arkansas, and then I went to the largest firm in the country, which is the Internal Revenue Service. And so I stayed at the Internal Revenue Service for 7.5 years and finally came over to the other side.
Yeah. Okay. I want to say to the fun side.
Well, definitely, like a lot of people don't know this, but this business actually started as a ministry because I was like ruining people's lives all day long with giving them, large tax bills. And so the first way that I kind of made myself feel better was I would start doing tax strategy for these people that I was auditing. And so I would do this. Think about this audit as like a consulting fee. And that way, like when you leave here, you're going to know how to save millions on taxes. So just look at this as a consulting fee. And then like that helped definitely. But then I was like, I've got to get out in front of this. Now, I never wanted to leave the IRS. So I thought you'd be rolling me out of there in a body bag because I thought I would stay there for the rest of my life. But so I started this little ministry at night helping business owners pay less tax through like church outreach. And so that helped for a bit too. But like finally I was like, I have to go out to the masses and really help them see what's going on because no one wants to be in the situation of having to pay a large IRS bill. And then I started, in this time, some of the richest people in America or in the world are from Arkansas. And so I got to look at some of the things they were doing. And I was like, oh my gosh, everybody needs to know this stuff. So I started teaching small business owners what I learned from the billionaires and how they can bring that back down and make a difference just on what they're doing with their taxes. So it's been amazing. I love what I do, and you're not going to find anyone that loves taxes more than me.
I, our CPA of many years, he's become a friend now, and he is like the walking tax code.
Yeah.
And I think Warren feels just as enthusiastic But hey, but I don't think it started for him at age 14. So I think you got the spot for the most passionate one for sure.
Well, it's not
And
about
yeah,
it's not with knowing the code. So this is what's so crazy. We have 3 ex-IRS agents that work here and a tax attorney that works there. And everybody's always like, Carlotta, it's not about knowing the most tax law because I clearly don't know more tax law than everybody else. It's just about using the tax law and angling it to understand how the IRS, like just saying like, okay, if you do this and this, it can impact your tax bill like this much. And so one of my best friends, it works for me now. She's an ex-IRS agent. She was way higher up at the IRS than I was. And she's always like, Carlotta, I can't even believe your brain thinks that way. Like, yet she'll say like, oh no, you can't do that one thing. And I'm like, just change this about it. And she's like, oh my gosh, you just made it where they could deduct all this extra money just because you shifted the mindset around it. So I think that's what sets me apart from most other people is I utilize that at the IRS. So like I would know from the IRS's perspective, like, okay, these are the issues. This is going to get disallowed and all these things would get disallowed, but I would always try to find like the one thing that the client could change to make it allowable. So know
yeah,
that it wasn't allowable for this year, but hey, if you change this thing or if you do this thing different, it will be allowable in the future and it will save you this much more money. And
yeah.
so I think that's what changes. That's
What
the
are
difference.
some specific examples of or the loopholes or deductions that you consistently see small owners not taking advantage of? Can you give us some examples like the ones that you were just mentioning, where
Yeah.
you're
So
based outside the box thinking about how you position the expense such that it's allowable as a deduction?
yeah. So I'll tell you, and this one actually has to do with real estate. So in real estate, if you buy an Airbnb and say you are going to have someone manage it for you, right? Well, if you have someone manage it for you and you don't have enough hours in it, you can't use that against other income, right? But if you just change that one fact, if you rent it out one time by the end of the year and you manage it through the end of the year, so like say you bought it in December 1st, but you managed it through the end of the year and you rent it out one time through the end of the year. Then that becomes, a deduction. You can do a cost segregation. You can offset that against your other income. But if you don't, like say you had a management company take that over right when you bought it, or you didn't rent it out the one time or whatever, every little circumstance that changes can make it where none of that's allowable that year. And so that's what I mean by just getting the facts and circumstances correct you might just need to be one thing that you change and now all of a sudden you have a $200,000 deduction where before you might have a $0 deduction. So that's what I mean. But like what are the things that people are missing out on? Well, I actually before I left the IRS I started out in real estate. So we have 42 doors of real estate. And what's the biggest thing I think you miss as in the real estate space is that you utilize a lot of things that you already had personally. And I think this happens in real estate more than anything else. But if you have a regular business, like you may have a computer that you started using that was personal before, now it's a business expense. But in real estate, it's usually a lot bigger items. So when we started out in real estate, we had already had things like trailers and tractors and shops and all kinds of stuff that were personal before we started in real estate. And then when we became real estate investors, now all of a sudden we started using those things for our real estate business. And so all those things could now become a deduction, even though we didn't buy them that year. Even if we bought them 3 years ago, all of those things that are now a deduction. So I want you all to, if you learn nothing else from this podcast, one of the things you should do is sit down and make a list of everything that you turned personal to business use when you started your business. And now my husband and I, we do this every year because actually, the longer we're in business in real estate, it's kind of funny because we'll have used like a lawnmower for a long time personally, and then we turn it into a business expense because now we have to use that lawnmower for all of our real estate or something like that. So that's probably the number one thing that I see real estate people miss out on the most. But also, don't forget once you get into real estate, the best way to start getting a lot more deductions is to start a real estate management company over your real estate. So, like utilizing the management company to kind of manage the properties, but also now you can use the Augusta rule, which is where you can rent your home to yourself for 14 days. You can utilize paying your kids. You can utilize employee benefit programs. You can utilize all these other things that you really can't utilize just by having plain old rental property, right? So once you get that real estate management company going, now you have all these other deductions that you can take. And also, it really makes managing your tax return and your real estate a lot easier as well. So that's what I'm going to suggest for real estate owners.
That's amazing. And I wanted to, I actually had a question where I was asking, I wanted to ask you between, that kind of like balance between asset protection and liability protection, and taxes, and because I know from experience as well in real estate that depending on how your LLC is set up with the IRS, whether it's an S corp versus a C corp, that there's different tax treatments, to different LLCs. And so what you're saying, what I hear you saying is you're gonna own the assets in an LLC, for the
It's not.
liability protection, and then you're gonna open a different LLC that is going to be manager, of the LLC that owns the assets, so that you can take advantage of all the deductions that you just mentioned.
Yeah, and you never have an S corp own real estate. So never do that. That is the one of the biggest no-nos is like do not put your real estate where it's owned by a corporation or an S corporation. So you always keep it separate. So for asset protection, you're normally going to do an LLC that owns the actual properties, and then you will do a management company that manages the properties. A lot of times there will be, and I'm not a lawyer, but a lot of times there will be um, an agreement between the LLC and the management company where you pay the LLC a flat rent or you get a percentage of the fees. And also, if you want to go one step further, you can have a trust own the LLCs that have the physical property in them, and then the management company can be owned by you, and you're running the management company. You can also have a trust own the management company and the real estate. So it really there's so much you can do in that manner that will give you asset protection, but also give you tax protection. Now, a lot of people don't go that far. Usually, when they're starting out, they're not really worried about trust and all those things.
Yeah.
But I'm gonna say, the bigger you get into real estate, you start getting worried. Like, okay, do I need to put this in a trust? And there's so many types of trusts you can do. Well, like, you can do like a Wyoming trust that is just for your assets, and so you still have access to them, but they're in a trust. And then you could do, or you can do like um, a spouse trust or something like that, or you can go ahead and do like a full dynasty trust or something. So, anyways, there's a lot of things that go in there when you talk about asset protection, but from the overall of just like when you're starting out or when you have, for me, I have 42 doors and I don't have all that trust stuff set up yet. I am in the process of it. But I do have LLCs that own all the properties, and then I have another LLC that's kind of like a holding company for those LLCs. And then on the other side, I have a management company that manages those properties. So I do have a lot of layers there just for protection.
Yeah, the same here, the same here. We have an LP, then we have LLCs that are disregarded entities that roll up to the LP that actually own the assets, and then an outside management company that manages basically the LP and the rest of the LLCs underneath. So, um, with time, but we started with just one thing, and then
Yes.
slowly, as you keep doing this, over the years. So for anyone that is, hearing this, don't compare your chapter 1 to chapter 15. And you got to start somewhere. And but if you had the opportunity, like Carlota was saying, to from the get-go, half the LLC that owns the asset and right away start an LLC. At least here in the state of Arizona, it's under $300 to, set up, a second LLC that becomes your management company. And it's a simple filing fee with the Arizona Corporation Commission, and you just need to find out what it needs to, what are the requirements in your state. But I'm sure that, any CPA or tax strategist will have a lawyer. I'm sure, Carlota, that you have also legal support, for your clients that need to be given a comprehensive strategy, as to how to, accomplish more in terms of tax savings, that you probably have, that key player as part of your team as well.
Right.
Yeah. So, next question that I have for you is, so there's a new administration, and regardless of the politics, that that administration or that we might have as small business owners and real estate investors, there's going to be things that are going to be changed on us, every 4 years, and that we need to either figure out how we're going to do differently because something comes to an end, or we are going to jump on it because there's something new that we could be taking advantage of, and that, we didn't know and we're currently not. Is there anything right now with the current administration that either was giving continuity that, for example, favors our real estate investors, or that just got started that will be benefiting real estate investors that of, or small business owners in general?
Yeah, so I'm going to say with real estate owners or business owners in general, the whole goal is to be able to exit whatever you're doing tax free, right? Because we know there's not a lot of things in the tax law that we can actually do and get zero taxes on. And so I think that real estate has a great opportunity with that, and opportunity zones where they can, exit tax free. And also, obviously, 1031 exchanges, it kind of just pushes it down the road. Um, eh, Letting your kids, and one of the biggest things I think in real estate that I see that is a huge mistake is, if you people a lot of times will leave their kids their real estate, and they give it to them like a few months before they die, or like a year before they die. Where if they would have just waited and given that to them upon death, would have gotten a huge step up in basis. And what does that mean? So, like, if I inherit this upon death, which means my parents die and now I get their property. Maybe my parents have no basis. Maybe they've, used all their basis to depreciate, their whole real estate portfolio down. And now I inherit this, and maybe it's worth $10 million. Well, if I inherit this at $10 million, I don't have to pay any taxes on that gain, right? Because that's totally tax free. There's no estate taxes. There's nothing. There's no taxes on that, right? Because it's 10 million, so it's below the estate threshold. I mean, it's totally tax free. Well, also, now, if these are still rental properties, you get to restart over the depreciation. So $10 million, now you're going to take that $10 million over the next 27 and a half years to 39 years, depending on what kind of property it is. So that's a huge mistake I see a lot of times that people make whenever they're trying to move real estate from one generation to the next. But either way, I want you to think through, how do we get this to the next generation or to the next place without paying any taxes? And that should be your number one goal. I teach this a lot in business acquisitions because there's a huge way that you can do this in business acquisitions with 1202s. But there's also a big way you can do this in real estate with opportunity funds, and then, obviously 1031 exchanges. What has the new administration done? They've given us a lot. They're giving us new opportunity zones every year. And this doesn't mean that it's just in like really bad areas, right? This means that it's just in a place that they want to see growth. I have I have several properties right now in opportunity zones, and they're actually in good areas. So that's something I would really try to focus on as we're getting those new opportunity zones every couple of years. And then new administration, obviously everybody's heard about this. If you're in real estate, they gave us back our bonus depreciation. So everybody should be doing cost segregations and making sure that you get that bonus depreciation and that you're paying as little tax as possible. I'm going to say after you hit real estate, you're gonna come to something else, right? Like, you're not gonna just stay in real estate because real estate's going to grow you, a large portfolio and a lot of wealth, but then what comes next? So it's either gonna be, syndications and private equity, companies, or it's gonna be, another business venture, right? And, like, maybe a business acquisition. So I'm gonna say there's lots of ways you can also exit those tax-free, but the bottom line is our goal is to get to a place where we can actually make a lot of money and not pay taxes on it. And so how do we get there? We have a training that we do every week called our Pathway to Zero. Definitely hop on that training and just learn the exact pathway you can take to get to zero taxes. But that is what I'm going to say is the biggest things that I'm going to leave you with today on the podcast.
Yeah. Thank you very much. That was very informative. Something caught my attention, and that is, it's not only real estate that is sometimes being transferred to the next generation, but sometimes, you know, there might be a situation where the older folks are either selling a business to their kids or selling the business outright to a different buyer. What are some things to consider there as far as minimization of taxes when it comes, there's, I don't know how many baby boomers right now that are business owners that the kids don't want their business, that they're trying to sell. There's, private equity or private individuals coming in, buying their businesses. What is there to consider in a transaction like that where you're selling your small business? Maybe it's a business that is making, I don't know, in profits anywhere between $1 and $3 million in profits, and in revenue anywhere between, I would say, $5 and $10 million. Like, do you know anything as far as like what can someone be thinking of or doing in order to minimize taxes on that end?
Right. So our new administration just gave us a huge leg up in this because right now we have private equity companies that are totally they're buying out all kinds of things, right? And so, you actually only have to start your planning about 3 years before you sell. So 3 years before you sell, you should be, getting someone to set you up all the strategies for a 1202 election because, in a 1202, you can actually exit a business 100% tax-free, if you hold it 5 years. If you hold it 3 years, you can exit 50%. In 4 years, you can exit 75%. So if that is you and you have a business that you're going to exit 3 years before you're going to exit that business, you hopefully you'll have 5 years because 5 years you could exit 100%, but at least 3 years before your exit, you've got to get that set up. So I would
And you said the 1202 classification is what you said?
the 1202 classification is what we're using to exit 100% tax free.
Wow, interesting. Yeah, because I know that is a big gap in the market right now. Like I follow a lady by the name of Cody Sanchez, and she's all about buying Main Street America and teaching a lot of people how to buy businesses from boomers that are retiring and where the kids don't want their businesses anymore. And so I'm just thinking, okay, if I'm the boomer, how can I help myself? But that's one thing I didn't know, and I'm getting up there. I mean, I will. Well, it's still one more year till I turn 50.
Well, one of the things what's so cool is you can't do this in real estate, right? But if you did this in a business, like if you say you did this, say like today, you go by maybe a construction company or like a roofing company or an HVAC, whatever it is, right? You go buy something Main Street America, and in 5 years you exit that. You could literally go and buy something for 10% down, exit in 5 years, and all of the gain from that exit be 100% tax free. So that just set you up for retirement, and then your real estate's really just added on top, right? And so, if you could
Carlotta, but is that
have
something similar to a 1031 exchange in real estate? Is it similar to a 1031 exchange
no,
where it
if
doesn't matter basically how you owned the asset, or to begin with you needed to have purchased the business in a specific construct or entity setup such that you can take advantage of this 1202 or 1252?
it's 1202, and, you don't need to have done like, you can actually own the business right now and get this set up correctly. You just have like, I wouldn't do it, like, more than 5 years out from when I'm gonna sell, because the way that you structure it, 5 years out, it's gonna you're gonna have to pay a little bit more taxes for those 5 years, but, not that much, maybe like 5% more, but then it'll be totally tax-free at the end.
Yeah,
So,
yes. Makes
but
complete sense.
it's not
Yeah.
the thing is you just have to time it. You just have to get your structure set up before you're gonna sell it. 5 years 3 to 5 years before you're gonna sell it. But that's what's so cool is, like, you could literally go buy a business now and in 5 years exit that business 100% tax-free. There's nothing else like that. There's nothing else like that, period, right? There's just not that much opportunity to be able to not pay taxes at all on a large lump sum of money.
Yeah,
So,
makes complete sense.
unless
Now,
you do a 1031, but a 1031 is just kicking the can down the road. This
yeah,
is no kicking the can down the road at
yeah,
all.
yeah, makes complete sense. Yeah. Okay, so we've been talking quite a bit about wealth, preservation, wealth transfer to the next generation. What does wealth mean to you, Carlota?
So, wealth means freedom. That's really all it is. It just means freedom because when you have wealth, you have an abundance that you can actually have the freedom to enjoy life. Like every amount of wealth what's the amount of wealth I need is going to be different from the amount of wealth you need. I always ask people, do you want to pay tax like the rich or like the wealthy? The rich, they look like they have a lot of money because they're driving around town in these nice cars and they have all this nice equipment. And what's happened is they usually have a tax strategist that has just told them to go buy a bunch of crap they don't need so they don't have to pay taxes. When you have wealth, you actually have assets that work for you, and the most wealthiest people in the world do not pay taxes, right? Like, if you remember when Donald Trump got elected last time, him and Hillary were on stage and they were debating back and forth, and Hillary said, "You don't even pay taxes," and Trump said, "That makes me smart." That is when I started going deep on what the billionaires do to not pay taxes because at that point, I didn't understand what they did. I didn't understand, like, they literally have a system to not pay any taxes. I knew how to pay less tax. I knew how to do those things, but when this happened, I guess it was like 7 years ago, I didn't understand that the wealthy have a system to pay 0 taxes, and so I've brought that back down to, upper middle class American, right? That where you can actually do the exact same thing.
Yeah, that makes sense. And I'm assuming Arkansas, you must be talking about the Walton family, yeah?
Yeah, yeah, the Waltons, they're all, there's the Rockefellers, a lot of the Rockefellers are from here, have books written on them of, like, what they do in taxes. So, very interesting, to get to, be around, be in the midst of people. Now, I'm not saying I worked on their returns. I can't talk about any of that, but I'm just saying, like, what they're doing, you hear, and so it's pretty cool.
Now, if a business owner comes to you and they say, "Okay, Carlota, this is how my taxes looked last year. We're fast, approaching April 15th or the end of the year, which means that by the time the following April 15th comes, I needed to have done things like right now. We're in August. We still
Yeah,
have
like,
things."
strategy, you're 8 months behind. Like,
But it can be done, so that by the end of December 31st, 2025, I will have minimized taxes. What is the first thing that you do? What are some of the steps that you take in order to help that, business owner reduce their tax liability?
yeah, so at this point in the year, you're still able to do our entire pathway to 0, but you're getting to where a point where you can't. So the first thing that we do is, we implement personal strategies. These are gonna be strategies that you only implement one time. I say personal strategies, they're not really personal strategies. You have to have a business or real estate to implement them, but there's 6 of them, right? Then we're gonna implement business strategies. These are things that there's over 100 of them. These are things like, you've heard of cost segregation, research and development credit, those kinds of things that, you can do per business. All right. Then we're going to implement a real estate strategies. And after that, we're going to, see do you need to do maybe another real estate acquisition? Do you need to maybe do a business acquisition? What does that look like after you've done all the other strategies? And so that is our pathway to zero. Like I said, you should definitely come on, listen to our whole training. It's about 2 hours of just pure content, pure like this is what you need to do to get to zero. So, yeah, that is what I would say is get your strategies implemented. See how much what all you need to do before the end of the year. Because if not, what's going to happen is you're going to get to December the 15th and you're going to be like, oh my gosh, what should I do to pay less tax? And it's going to be too late. So make sure that you understand tax strategy ends. Very last day is December 31st. But don't spend your December 31st going to buy a new car because you get some extra bonus depreciation. Like, let's get started now so that you actually can grow your wealth and have tax free wealth, not just pay tax like the rich. Like the rich, yeah, they might not pay any taxes, but it's because they've taken out a bunch of loans and they're sitting here buying a bunch of crap they don't need because they're trying not to pay Uncle Sam.
Yes, absolutely. Now, one last piece of advice that you might have for anyone, starting out, and how can people, get a hold of you if they're, interested in working with you in some capacity?
Well, you're gonna have a link in your show notes, for your group, but also you can come to taxstrategistofamerica.com or carlottathompson.com. Tax Strategist of America is gonna be the best website. You can also find me on TikTok, Instagram, Facebook. And what's my top lesson or takeaway for you people that are starting out or that you're already in business? I'm gonna tell you that it's all about who you surround yourself with. So make sure that you, if you don't pay to learn the lesson, you're going to pay with your time. So the quicker I can learn a lesson by paying for it with money, I'm going to always be better off. So if you're just starting out, you need to surround yourself with people who are where you want to be. So whether that is advisors, like a lot of times people will they'll start out with an accountant and I'm going to tell you, accountants are usually terrible business owners, meaning they don't really have a business. They just are kind of self-employed and maybe they have a few employees, right? Um, you need to align with uh, accountants. You need to align with finance people. You need to align with operations people that are where you want to go. So I run 7 businesses, and our largest is between 10 and 15 million, and I have 42 doors of property. So if that's where you want to go, then you should surround yourself with our team, right? Number 2 is uh, surround yourself with like-minded people that are ascending where you want to be. So I always say that my mentor is why I am where I am because I was someone making $300,000 a year in business, and I was making all the mistakes, right? Like, I didn't believe in myself. I didn't understand, like, how to get to the next level. I didn't know anything. And so surrounding myself with people that are going through the same things as me, but at the same level. Like, I want to be the dumbest person in the room, and that is what I'm always caring for. I do not want to be the smartest. So be in a room where you're the dumbest, where you're making the least, and learn from those people that you can surround yourself with. So, like right now, I'm trying to surround myself with like people in private equity, people that are doing larger deals, people that are actually in business that are making 50 to 100 million, because that's where I want to go, right? And so I'm going to tell you, pay to be in those rooms, and don't think anyone owes you anything. And that's what I'm going to leave you with. Just surround yourself with people that you want to be like.
Make yourself, make sure that you jump into a bigger bowl versus the pond where you've been playing and where you feel comfortable. Absolutely, totally.
Yeah, because we always like human nature. We want to be the smartest in the room. Like, we want to be, the top. Not me. I want to be the dumbest. I want to be able to be like, I don't know any of y'all because everybody rises, right? Like, I love being in the rooms where people are like talking about how they're selling, their $200 million or $1 billion business. Like, that's what I surround myself with. So, um, you don't need to surround yourself with those people until you get to that place where you get to like 10 to 20 million. But because there's a lot of different things, like your first step is 0 to 100, right? You need to be eyeing for the 100 to $500,000 mark. So 100,000 to 500,000. And then it's like 500,000 to a million to 5 million, 5 million to 10, 10 to 20, 20 to 100, and then 100 to a billion. So those are kind of the breakdowns of where things really drastically change between each of those different models.
Yeah, in terms of what you're doing, what you're focusing on as an entrepreneur, as a CEO, and the things that you, quite frankly, need to be doing to save on taxes. Absolutely, totally, couldn't agree more. Carlota, thank you so very much for coming here on the Becoming Wealthy podcast and sharing your expertise, your passion for taxes, and most importantly, for helping business owners, not have to pay things that they don't have to. This is all legal, legal deductions, legal constructs, legal strategies, on the personal business and real estate side that you were mentioning, that people should know about. Because I know my CPA always says, you got to figure out how you want to pay taxes. You want to pay taxes like the poor. Those people usually are the ones that pay the most, or do you want to pay taxes like the rich, which are the ones that are, like you said, in that interview where Donald Trump was being asked or something like that, and he's basically being smart about how he is going about reporting his income and using legal strategies to minimize his expense, and use actually every single dollar that that his businesses spit out to actually continue that beautiful thing that is called compounding, that all of us investors are looking for, and you want to compound with before tax dollars, not after tax dollars. So thank you so much, Carlota, and looking forward to staying in touch.
Thank you. I'll talk to you soon.
Thank you.